Welcome, entrepreneurs, students, and taxpayers. This is The Tipping Point, a show devoted to individuals trying to get ahead. We scour the region for the most competent individuals in their business-related fields and allow them to educate us on the sort of specialty because knowledge is power, and with power, you can actually tip the scales in your favor. I'm your host, Gabriel Velez. The Tipping Point is brought to you by Terrani and Velez LLP, a tax and accounting firm headquartered in Irvine, California, catering to closely held businesses. As a reminder, if you like today's content, please remember to like, share, and subscribe. Today's guest, Pat McCredie with Voit Real Estate Services. He's a commercial real estate broker focusing on office and industrial commercial real estate in Orange County, California. Welcome to the show, Pat. How are you doing today?
I'm doing well. Thanks, Gabe. It was a pleasure to be on. Appreciate
Fantastic.
it.
I appreciate this. And for those of you who don't know, this is actually our inaugural podcast.
Yeah.
And so we have a very special guest for us today. And, the goal of this podcast is really just to educate people. And so I'm bringing in, different experts in their fields. So today we have Pat McCredie. He's a commercial real estate broker working for Voit Real Estate. And, really, I just want to learn a little bit about commercial real estate and what makes it tick. What exactly is commercial real estate?
So commercial real estate is anything that is not residential real estate. So when you think of residential real estate, you think of single family homes. But an interesting thing is that residential real estate is classified as a single family home in any complex, any residential complex up to 4 units. Any complex beyond 4 units or 5 units is considered commercial. Beyond that, I kind of call them the commercial real estate food groups. So you have your office, which is basically just office buildings. Beyond that, you have industrial. So industrial buildings are buildings that have warehouses. Maybe someone has a manufacturing or machining shop. So that's group number 2. Group number 3 is retail. Strip malls that you see all over, big box malls like Walmart and major stores like Bloomingdale's. Those would all be considered the retail group of the class. And then the last group is multifamily. So as I mentioned before, anything above 5 units for residential real estate is considered a commercial real estate asset class. So big apartment complexes would be one example. A 5-unit small complex as well would be another example. So retail, office, industrial, and multifamily constitute the main food groups of commercial real estate.
Fantastic. Okay, so what do you think is the allure of real estate, specifically for business owners?
Well, one of the main allures of real estate for business owners is, the example that I often give to business owners is you're taking a percentage, if you are leasing a space, you're taking a percentage of the monthly amount that you pay in rent and converting that into equity. So you have your principal and you have your interest when you're paying down debt on real estate. But one of the beautiful things about owning a piece of commercial real estate, particularly as an owner-user of a business, is that principal is being converted slowly into equity into your business. So you're building wealth within the business while you're operating there as well. Another interesting thing is you can depreciate real estate. So the depreciation aspects of real estate can be alluring to businesses. You can write it off on your taxes. I believe for a commercial asset, it's a 39-year straight line depreciation.
Correct.
So that's another real allure of real estate. And then the third one is you can control your operating costs. Here in Orange County, commercial real estate, the inventory is very low and it is relatively expensive. But if you are patient and wait out over time, you are going to, on a square foot basis, have a more stable rental income by paying down that principal and interest as opposed to if you're just paying rent. So you're essentially able to control your operating costs, your occupancy costs in that fashion. And, payroll number 1 and rent number 2 are primarily some of the biggest line item expenditures for any business. So your ability to increase the equity in your building, build wealth, control your operating costs, and control your business are some of the major benefits for an owner, user, and occupier of commercial real estate.
Okay, so what I'm hearing is you're able to hedge against inflation, right? So as prices, as the relative prices of rent and other goods increase,
right,
you're having a straight line expense,
right?
And likewise, you're actually maybe planning for retirement,
right,
or for further investing in the future.
Absolutely. And one of the cool things about real estate, and you see this especially because there's a lot of entrepreneurial people in Orange County, particularly a lot of small to mid-sized businesses. It is a great estate planning asset for your children. We see this all the time, especially on the industrial side, you have, a 15 or 20,000 square foot fee simple standalone building. Well, when that building's paid off in 30 years and, the principals of the company retire, they may leave it to their children, and that building becomes re-rented and it becomes a source of cash flow for their kids. So it's a beautiful thing to leave to your, your children or your spouse or someone else. Once the building's paid off, it may have, an equity of, just as an example, $3 to $5 million, and it throws off, X number in dollars in cash flow a month. So it's really a cool investment vehicle for the long term and a practical one in the immediate term for your business needs.
Fantastic. Yeah, and I can speak on that a little bit. One of the greatest gifts or one of the greatest parts of the tax code is actually the step up in basis, right?
Right.
Which happens when a decedent leaves an estate or a trust and leaves it to the beneficiaries, and they get a step up in basis. So a property that maybe was purchased for $1 million at one point and appreciated to $3 or $5 million, like you were talking about, would actually have a basis of $3 or $5 million after the decedent passed away and the beneficiary received it. And so that means a day after the decedent passed away, of course, you're not planning for it, but if you sold that property, you would have zero taxable gain on that property because it now has received a step up in basis to the market value at the time that the decedent passed away. And so it's like you said, it's a great estate planning tool. It's how a lot of people carry their wealth into the next generation. And with the latest tax changes, they've actually just about doubled that benefit by making it a person having an estate of $10 million as a single person or $20 million married filing joint. They can actually pass that on to the next generation without incurring any estate taxes.
Yeah, that's tremendous.
And yeah, it's a huge benefit in the code, and definitely another really great reason to have a real estate in your portfolio. So let's educate us. I want to be educated on if I'm going into commercial real estate
Sure.
as an investment,
right?
What are some of the terms and what are some of the lingo that you guys use in order to kind of compare these different properties?
Right. Okay, so I'll go through a couple of them with you. One kind of the quick and dirty back of the napkin tool to assess the value of a piece of real estate in a given commercial market is cap rate or the capitalization rate. And essentially what the cap rate is, it's the net operating income divided by the assessed market value of the property, and that will give you a rate of return. The capitalization rate, across asset classes in Orange County right now is, between 3.5% to 4.5%. So it's relatively low. But that is kind of one of the first things that a lot of people do is they'll ask, what is the cap rate? Number two, people will ask, what are the comps? So, comps are a significant tool, and people that have purchased a home as well will have the same tools. The comps are essentially what prices commercial real estate has sold at in a nearby area with comparable amenities for the property. So if a piece of industrial real estate is sold for $235 a square foot down the block from you, as long as that property is of a similar nature, built in a similar time period, and has a similar amenities, you can reasonably assume that property is going to be about $235 or $240 a square foot. Now obviously there are some extenuating circumstances to that, but those are some basic guidelines that can help guide real estate investors. Another thing that you have to consider, especially from an investing standpoint, is the financing of real estate itself. As an owner-user, if you qualify, you can get an SBA loan for 10% down, which is significant, and that's wonderful. For an investor, it's going to cost you a lot more. The loan-to-value ratio on a investment piece of real estate that is a solid piece of real estate that the bank has underwritten and done their due diligence on is going to be 75%. So the loan-to-value of 75% means that you have a down payment of 25%. Even on $1 million piece of property, that's $250,000. So that's a significant chunk of change. So those are things you have to kind of consider when you're going into it. But as a general rule, the metrics that we use initially to look at real estate are the capitalization rate and then recent comps in the area to make a determination as to value, and then you can go from there to determine what your financing options are.
Okay, so you touched on a couple of different things, and,
Sure.
and I kind of want to jump in on them. So,
Absolutely.
When you're investing in real estate, right, you're looking at two different things, right? So like the cap rate is going to help me determine how quickly I'm going to cash flow, right? So like, am I going to have to be coming out of pocket every month, making my mortgage payment
to service the debt?
Yeah, exactly. Yeah. Or, am I going to have maybe a little positive cash flow? And then the other side of it is I'm actually looking for appreciation in that property, right?
Right.
So you were talking about low cap rates in California,
right?
But actually we have some of the best appreciation.
Absolutely.
If you could withstand and kind of weather that storm of having to, deal with the cash flow issue, right?
Right. And you really bring up a good point. There are a lot of investors, especially investors, trying to chase yield or a more immediate return. They may go to, secondary markets. They may say, hey, Colorado for multifamily or industrial has a much better immediate return. So there may be instances there, or, Tennessee or Nebraska, where you're able to, get the property, finance it with 75% loan to value ratio, service the debt, and have a positive cash flow after that. In Southern California right now, that is almost impossible to come by unless you're putting down, 50, 55% in a down payment. So you bring up an excellent point. One of the beauties of Southern California is this market in particular. New York might be another one, and parts of Florida, they appreciate much more significantly than the rest of the country. So if you're able to hold out, the financial, wherewithal and basically ability, you can see, or you can turn around that property in 5 to 10 years. You may not see that return, but you're going to see a significant appreciation. And that's what a lot of investors in Southern California are banking on, especially in more attractive markets like Los Angeles, San Diego, and Orange County.
All right, very good. Okay, so let's flip the script a little bit.
Sure.
We're talking about commercial real estate as an investor. Can we talk a little bit on not so much as an investment, like a third party, like you're going to have a tenant in there, but I'm talking about like user occupied, right? So I'm a small business. I'm looking into the market and I'm trying to find that piece of real estate that's going to help me grow my business.
Right.
What kinds of things am I looking at in that case?
From a purchasing standpoint or a leasing standpoint?
Let's do purchasing and then jump into leasing afterwards.
Okay.
Yeah.
So, what you're looking for from a purchasing standpoint as an owner user as opposed to investor is ultimately, number one, am I going to be able to afford this building with the debt service, right? And then number two, ultimately, does this building work well for me? So for an investor, really what they're looking at is more, hey, what is my anticipated appreciation based on historical returns? And, what is my immediate cap rate and how much money am I going to have to put forth? Some of the similar questions exist for the owner user, but fit is obviously one of the most important issues. Where is this particular industrial piece of property, or where is this freestanding office building in relation to my employees? Is it convenient to major freeways? Is it convenient to my client base? It's particularly of interest on the industrial side. Does this building have sufficient clear heights? Say you want to get the most out of your building in terms of the warehousing in the back, and a building that may fit the bill in terms of geography it was built in the 1960s and only has a 14-foot clear height. Well, if you can get a building with an 18 or 20-foot clear height, you can, increase the amount of storage in that space by, 20% or 30%. Well, that's a huge cost savings for a person. And the same goes with the electrification of the building. Is it powered right if it's a machining shop? So all of those kind of questions really come into play from an owner user standpoint that wouldn't necessarily be of a significant concern to an investor, so long as they understand, hey, maybe if it's an older building, these type of industries may be precluded from it. But if it's your own building, you really got to take a hard look at that. I know the last thing I'll touch on, and both sides have to look at this, but it's particularly important for the owner user because they are there, is doing really sufficient due diligence on the deferred maintenance of the space. If you have an old HVAC unit or an old roof, well, those are things that you really have to negotiate and take a good look at because you're the one that's sitting in that building for the next 20, 30 years.
Gotcha. Yeah. Okay. So you touched on the functionality and the safety of the place
Right.
that you're actually looking at, and I was going to actually start with like the marketing perspective, like, right, does my business need some kind of visibility from the street and things like that?
Yeah, that's important too.
That's also a factor, right?
Absolutely.
Okay. Great. All right. So let's jump into leasing.
Yeah, sure.
I know you're an expert on
Yeah,
leasing and negotiating leases.
Yeah.
All right.
We do that a lot.
Okay. And so, there's different types of leases, and those different types of leases, depending on what kind of property you're going at, you're going to get a different type of lease most of the time.
Okay, let's just start off with the basics then. Okay, so there are kind of 3 different types of leases. I do primarily office, so we deal with full service gross leases. So for the standard office user, you are going to get a full service gross lease. That means that your asking rate or the base rent, everything is included in that. Maintenance, utilities, and insurance. So most standard office users are going to be in a full service gross scenario. That's number 1. Number 2 is modified gross. There are some office parks where they carve out, it's called a carve out, some of the expenses, and you pay those in addition to the base rent. So for purposes of example, let's say a full service gross lease is $1 per square foot per month. For a modified gross lease, it's the same $1 base rent, but you may have additional expenses that are carved out that you have to pay for. A perfect example on the office side is where you have sub-meter units within the office complex itself. So you're paying $1 base rent plus your electricity costs. Another instance of modified gross is you pay your $1 base rent plus your electricity and your janitorial costs. In a full service gross, everything is included. Modified gross, there are certain carve-outs. The third term is called a triple net lease. Now, by and large, I mean, it's not a hard and fast rule, but most often on industrial properties, you're going to see a triple net lease. Triple net lease means you pay your base rent. Your base rent may still be $1, kind of keeping with our example, but you pay taxes, maintenance, insurance, and utilities. The nets are maintenance, taxes, and insurance. So you are essentially responsible for all the additional expenses in the building. So when you're investigating these different types of properties, you really have to ask those hard questions. In a modified gross lease, what are my additional expenses? In a triple net lease, you at a minimum you're paying maintenance and taxes and insurance, but you need to ask, the landlord, what are our estimated costs for the year, and what do you think my utility costs are going to be? And the interesting thing on a triple net lease is too, your utility costs may differ a lot. If you're running power 24 hours a day because you're doing welding in there, or it's a chroming shop, it's going to be drastically different than if you're an import-export place just stacking boxes and you have a forklift. So those are kind of the 3 different types of leases that you commonly see for the different asset classes you're dealing with.
Okay, and these aren't hard and fast rules, right? So
No.
there's a little wiggle room in between each other. These are like blanket terms.
Yeah, these are blanket terms, and that's why you really have to, ask the hard questions. Because, if you think about it, there's no one corporation that owns all real estate in the United States. They're owned by people like you and me. They may be, mom and pop business owners that have a vastly different interpretation of, what they think is fair and what they think ought or ought not to be included in a particular lease. So you really have to read the lease language. And especially if you're dealing on more of the mom and pop side and office buildings, they can be absolutely wonderful tenants, but they may have different interpretations. Their leases may be old. If you're dealing on the institutional side, they may have differences as well. So, you just ask those questions up front so you have a real clear conception of, hey, what am I really going to be paying in this lease? And, because you don't want to have a gotcha down the road. Those are not hard and fast rules, but they're kind of general rule of thumbs.
Got it. Okay, so you probably don't want to be negotiating your own lease unless you're like really well versed in real estate, right?
Or the landlord's a really good friend of yours, which does happen occasionally.
Well, money's the root of all evil.
Yeah, so, exactly.
Many of friendships have been torn apart by money here or there, right?
And I've seen more than one.
Exactly. Yeah, me too. In my business,
I
see partnerships. Kind of.
You probably more than me, honestly.
Okay. All right. Great. So, So let's jump into real estate, right?
Sure.
So, we're already in real estate, but what I'm talking about is real estate as an investment is really a long-term play, right? Because right now, we're at the top of the longest bull market in
history,
but both in stock market, but both in real estate, right?
Correct.
And so real estate's a little expensive at this point. Let's be honest.
Yeah,
right?
There's no doubting that.
Yeah. So you're not trying to get into real estate because you're gonna sell that piece of real estate, 2 or 3 years later, unless you have like a really good plan of like improving the property or that the area is developing or something like that, right?
Right. That's absolutely true. But even still as a developer, for raw land you're paying a lot right now too. So across the board it's very expensive. Real estate by and large, you see the housing flippers on TV shows, and those are quite popular. But those in my opinion, are not a great reflection of a prudent investor by and large, because it's a difficult kind of proposition to achieve. By and large, the people that make money in real estate are the people that are patient. They make a good purchase in an area that they deem is stable and has the ability to appreciate and is attractive to other people and businesses. And historically, over time in the United States, and particularly in California, despite the ups and downs in the real estate market, it has generally appreciated. There's volatility just like any other asset, like if you owned a stock or a bond, but the long-term prudent holders are the ones that really benefit. And to your point regarding, purchasing right now, yeah, if you were an investor and you said, hey, is this the absolute best time to get into real estate? The honest answer is no. The best time was probably, if you wanted to really drastically increase your yield or return on investment and appreciation, was 2008 or 2009. But if your trajectory is long, either as an owner user or as an investor, especially in Southern California, that asset will appreciate.
Okay. Can we talk a little bit about local economy? So right now we're in Irvine, California.
Yep.
Our office is off of Irvine Center Drive and Bake.
Yep.
There's massive amount of development going on around here.
Yes.
And so, me as a commercial real estate owner in Irvine, I think the outlook is positive.
It is
for the long term, right?
Right.
And so, is the Irvine Spectrum area is that like planned to be the central hub of Irvine in the future, or are they concentrating more towards John Wayne Airport? What's the news there?
The former is the answer. So 200 and 400 Spectrum. I don't know if you see those beautiful glassy buildings off the left-hand side of your drive.
Absolutely.
Yep.
Yes.
So I think it's Mazda has one of the tops and Cylance has the top on the other one. So those are two examples. Those are by and far the nicest office buildings currently in the county of Orange. Those were built by the Irvine Company, and the general trajectory and the general move is to move away from the CBD, the Central Business District, which is essentially Newport Beach, Costa Mesa, and northern Irvine, down to the Spectrum area. There is a general trajectory towards that. A lot of it's driven by one company, the Irvine Company, which controls a lot of the land and a lot of the development. They are an excellent landlord and they develop smartly, but what we are seeing is a general gravitation towards the Spectrum area because there's more of that work, live, play lifestyle. You're relatively close to the university, and you're relatively close to new housing and a massive commercial district that's continuing to grow. The Bacchus buildings were kind of a toe in the sand, or toe in the water, so to speak. And you're in a Bacchus building right here, and that was kind of like one entree into the Spectrum area. It's continued along that trajectory. So, my anticipation is that the airport area in the Central Business District will continue to be, in the immediate term future, the main business hub of Orange County, for the simple reason that it's right next to the airport. For a 20-year trajectory with Great Park and, the new Broadcom buildings and 200 and 400 Spectrum and all the development and all the residential going down here, this, in my opinion, is going to be kind of the new central hub for business in Orange County, and particularly in Irvine.
Great. Okay. So let's back it up a little bit and talk about what kind of cash flow items
sure.
we're going to be looking at. I'm an accountant by trade.
Sure.
So
you can speak more eloquently than me.
Maybe together,
yeah.
We can have some kind of a halfway coherent explanation here.
We can put something together for sure. Are you talking about cash flow just on like a property?
Well, let's talk about line items, right?
Okay.
I'm all about line items.
Sure.
And
let's talk about line items.
This way people don't kind of have, if somebody's deciding that they're going to go out and they're going to buy a piece of real estate.
Sure.
I don't want them to have any surprises, right?
Right.
So, what that surprise, operating expense that I didn't realize I was going to have to pay. And
right.
now I have less cash than I thought I really did.
Right. So, from an investor standpoint, just putting together a reconstructed operating statement, your top line item is going to be potential gross income. Less of that, you're going to, any prudent investor is going to have, a line item for vacancy. Mm-hmm. That gives you your effective gross income. And then you have a bevy of expenses, including insurance, property tax, maintenance, incidentals, utilities, and anything else that comes up. So you've got your potential gross income less all of those expenses. That gives you, this is a quick and dirty version. You can elaborate more. It gives you your net operating income. And below that, then you have your debt service, and that gives you your total cash flow in a property. So that's a way, when I'm putting together an analysis very quickly for someone, that's what I do. And there are general, and you may have different terms for it, but there are kind of some general metrics that we use. For most commercial property, we use like a 35 to 40% expense ratio, so you can even do it quicker by taking the potential or effective gross income and timesing it by 0.60, and that'll give you, approximately what your pre-debt cash flow is.
Okay, great. Okay, so I have one more.
Absolutely.
I have one more cash inflow that non-accountants aren't going to be actually privy to. Yeah,
please tell me. I'm learning too.
You know what it is, but you don't necessarily see it as a cash inflow.
Yeah.
Which is actually depreciation.
Yeah, that's true.
And so this is from an accounting perspective. If we're looking at a cash flow statement, and the reason depreciation is a cash inflow is because you don't pay for it.
Yeah.
Exactly. It's a deduction that you don't have to pay for. I mean, of course, you've paid for it at some point because you put the investment in, right?
Right.
But now I'm able to take that as a deduction on my tax return. I'm able to deduct it on my income statement.
Right.
And, that subtracts the amount of taxable income that I have at the end of the day. And that's a very good thing. And that's, and there's a lot of, there's even a science behind how to structure assets in specific classes to accelerate the amount of depreciation that I can take. And that way I can kind of cash flow a little bit earlier on my properties and not have to pay Uncle Sam, our hard-earned cash.
Okay, Velez, I should talk to you about that too for some of those strategies, because I only know 27.5 and 39% for, I think 27.5 is, I don't even know if that's correct anymore. It's for residential, and 39 is for commercial.
That's correct. Straight line. Exactly.
Yeah, but beyond that, I don't have any other tricks of the trade, so I'll have to talk to you afterwards.
All right. Yeah, we'll talk a little bit offline. Okay. All right, great. So what other topics did you want to discuss today?
I think
that I haven't hit on.
I think that we've done a good job covering it overall. Let me just take a quick look here. Oh, let's talk about the last thing that we can go over that would be helpful maybe to your listeners is just what leasing economics and the common concessions you take from that. That's a great note. So, we've kind of talked about how leases are potentially structured for, a rental rate basis from the landlord perspective. Things that you can look for concessions, and these are just kind of like the simple ones that you should probably always look at, are number one, your asking rate. So just like you have comps for a recently sold property, there are also comps that are available for recently transacted leasing deals, and those give you a very good barometer of what the landlord's willingness is to rent your property at a specific price. And another interesting one is if there's a building right next door to you owned by a different landlord, you can use that as a bit of leverage, just like you could in the purchase of a home or industrial property or commercial property, to use that and say, hey, there's vacancy next door and the landlord gave me this price, and we want you to be able to match it or come close to it, and we can make a deal. So number one, as far as concessions are concerned, is simply reducing your per square foot asking rate. Number two, and most people who have entered into leases already know this, is free rent. So, depending on the tolerances of the landlord and how much they want you, they will give you, a couple of months of free rent for your lease. As a general rule, most leases are, and this is also up to negotiation, but most leases are 3, 5, and 7 years. You can reasonably expect in this market to receive 1 month of free rent per every year you're leasing. So if you're in a 3-year lease, at a minimum, you should probably be able to get 3 months of free rent. And then the last one, and the most expensive initial capital outlay for a landlord, and this is something where a lot of tenants may not see the immediate value, but it's really a huge thing, is the TI allowance. So, we work on deals all the time, but, to add a couple of additional offices or, relight a place and repaint a place, those all take a lot of money. And that's money that the landlord has to put up upfront in order to make the place more desirable and basically build it out to the specifications of the tenant. Now, there are certain ways they can recapture those costs. The most obvious one being just extending the lease, so there's more cash flow in place for them to make back the amount of money they put forth. But there are significant costs associated with building out an office that people don't really think. Re-electrifying it. Title 24 is a big one too. There's California energy compliance codes that dictate, if you move a wall from a building that's already existing, already coded, you have to go through and do all these energy efficiency things, which ultimately is great and enhances the value of the building, but in the short term, it's very expensive. Reducting. So, people don't really think about the fact that, if you move around a bunch of offices, you have to put in ductwork at the top of the below the ceiling to get the HVAC or to get the air conditioning running. And then lighting is the last one, and then paint and carpet. So all those things that are expensive, and if you can negotiate those plus a reduced asking rate plus free rent into an effective lease package, you've really won.
Okay, as an incumbent lessee, do I have more leverage than somebody coming in and trying to negotiate a whole new lease?
An incumbent lessee has more leverage if they are indeed a good tenant. So that's the caveat. Okay. We get in our buildings. So I know you laugh, but that's the real caveat. There just as there are bad landlords, there are absolutely bad tenants, and there are some tenants that don't pay the rent on time. There are some tenants that we have that do pay the rent on time, but are just such a pain in the butt because they're making all these demands, and they can be difficult that the landlord would just rather have a new tenant. But by and large, an incumbent tenant who pays their rent on time, who is respectful of the building, whose maintenance requests are within the realm of reasonability or reasonable, those tenants have absolute preference over a new coming tenant. For the simple reason is they've been pre-qualified. You don't have to pay leasing commissions to relist the space, and you don't have to pay TI because by and large, the new person coming in is going to want to have an office change here or there, is going to want new carpet, may want different lighting fixtures, may want different, paint colors or, hardware on the doors and so forth. And that all costs money. The biggest rule of leasing is cash flow. Having a person in that may be paying 5 cents under market is better than sitting on the space for 3 months with no cash. And you can probably speak to that better than anyone.
Absolutely. Okay. So one more thing, because I want to backtrack a little bit. You were talking about comps, right?
Yeah.
So this is the information age. You can get almost any amount of information online if
Absolutely.
you search and you have the time for it, right? And so like in the residential space, I can go on Zillow and Redfin and get pretty good data on what's listed currently, how much everything has
Totally.
actually sold for. Can I do the same thing for commercial real estate? There's LoopNet, right? But anytime I log into LoopNet to try and figure out comps or to see what's on the market, it always seems like I'm missing a big slice of the pie and big slice of the information.
It's definitely much harder. That's why commercial real estate brokers have subscription services. LandVision is one that we use regularly, and basically what they do is they pull comps from the title offices and recorder offices of each of the counties. That's a big to-do. It is more difficult for the simple reason is that there's not nearly demand for it. In the United States as a whole, there's not a lot of people that can afford to leverage and finance a $2 or $3 million commercial piece of property outside of their home. So having comps for residential properties is just much more interesting to most people. So that's one of the reasons that they're harder to find. And the second reason is they just aren't as available in general. And on the leasing side as well, those are proprietary. So no landlord has it in their interest to put the comps of recently transacted deals online. So those are virtually not impossible to find, but very difficult. And that's why it's kind of nice to have a broker, and I don't know all the comps for every one of the buildings, but you can ascertain from transactions that have occurred in and around a building where approximately a landlord is going to be willing to make a deal. And that's where kind of the value comes in for securing a broker for your leasing transaction.
All right. Sounds good. Okay. So if there aren't any other big topics that you want to discuss.
No, I think we covered a lot of ground.
I'm going to wrap it up. Okay, so to close, I'm going to start throwing out a few terms.
Sure.
And then if you could just spitball, what's the first thing that comes to mind? Or
it's like a psychology office.
Yeah, exactly. Okay. Yeah, exactly. That's how we're going to wrap it up today.
Okay, sure.
So letter of intent, what is that? LOI.
Letter of intent is the first horse out of the gate. It's a non-binding agreement that dictates the terms that your client wants, and then you get countered towards that.
Okay. Net operating income.
Net operating income, we've discussed it before. It's just the income that you would receive on a property after all expenses are paid before depreciation and debt service.
Okay. How about PSA, the purchase and sale agreement?
Purchase and sale agreement is basically a step forward from an LOI. It dictates the literal definition is it dictates the terms of a sale and provides the escrow officer instructions for transacting an escrow.
Due diligence.
Due diligence. Due diligence is far and beyond the most important piece of information for either residential or commercial purpose. It is the process of investigating the feasibility of a property from an economic and environmental and structural standpoint before you make your final purchase. And there's what's called a contingency phase in which you transact your due diligence before your money goes hard.
I got two more for you.
Sure.
Escrow.
Escrow is literally just the process before the sale or before the close of a property. It's the process of transacting all parties, bringing everyone together to close a deal.
Commercial real estate.
Commercial real estate, as we've discussed before, the literal translation is any residential complex that has 5 units or more, or industrial, retail, and office properties. That is the commercial real estate realm.
Fantastic. Thanks, Pat. Thanks for being on today.
Yeah.
Before we close, once and for all, how do people find you?
How do people find me? We are putting together a website right now, but they can just go to voitco.com and they're able to find me there, or on LinkedIn.
Patrick McCredie, operating out of Orange County, California. Thanks for listening. Bye.
Been a real pleasure.